The doors of America's banks are locked. It's March 1933. Outside, crowds gather in silence, not shouting, not rioting, just waiting. Inside, clerks count what's left. Cash drawers are empty. Vaults echo. The system has stopped breathing. A farmer in Iowa cannot withdraw his savings. A factory owner in Detroit cannot make payroll. And in Washington, a new president signs an order that effectively freezes the entire banking system overnight. This is not just a crisis of money. It is a crisis of trust. Within days, a series of decisions will redraw the invisible architecture of finance. Decisions that will determine not just who keeps their savings, but who builds wealth for the next century. Because what emerges from this collapse is not just stability. It is a new set of rules about who is allowed to take risk and who is protected from it. So the real question is this: how did a system designed to prevent another collapse end up reshaping who gets rich in America? At the center of this story is a simple problem. Before the 1930s, banks are chaotic hybrids. They take deposits from ordinary people, your savings, your paycheck, and then use that same money to make speculative bets in the stock market. There is no wall between safety and risk. Think of it like this. Your savings account is not a locked box. It's a shared pool. And the bank manager is free to walk over to Wall Street and gamble it. When the market crashes in 1929, that gamble is exposed. Thousands of banks fail. Depositors lose everything. The promise of banking, that your money will be there when you need it, collapses. Enter the reformers. In 1933, Congress passes the Glass-Steagall Act. On paper, it's a technical regulation. In reality, it's a philosophical shift. The law does two critical things. First, it separates commercial banking, taking deposits and making loans, from investment banking, trading securities, and underwriting deals. Second, it creates the FDIC, which insures deposits. Here's the promise: your savings are now protected. Even if the bank fails, the government guarantees your money. It sounds like stability, and it is, but embedded in this solution is a quiet, powerful trade-off. Because while risk is removed from the everyday depositor, it is not eliminated, it is relocated. Now imagine the system as two parallel tracks. On one side, commercial banks, safe, regulated, insured. They take deposits and make predictable loans, mortgages, business credit. Returns are steady but limited. On the other side, investment banks, uninsured, unregulated by comparison, free to innovate, to speculate, to chase higher returns. The separation is clean, too clean, because wealth over time is not built in the safe lane. It is built where risk lives. As economist Hyman Minsky later argues in his financial instability hypothesis, stability itself breeds risk-taking. But now, that risk-taking is concentrated in specific corners of the system. This is the central paradox. The system designed to protect the public from financial risk also limits their participation in its upside. Over the following decades, this structure spreads. Pension funds, insurance companies, and eventually mutual funds begin to channel money into markets, but access is mediated. The average person participates indirectly, cautiously, often late. Meanwhile, investment banks evolve into engines of capital. They fund corporations, underwrite IPOs, and build complex financial instruments. They sit at the center of wealth creation. And because they are structurally separate, they operate under a different set of incentives. Now, walk through the plumbing of this system step by step. A depositor puts money into a commercial bank. The bank lends it out, say, as a mortgage. That loan generates modest interest, safe, predictable. But a corporation seeking to expand doesn't go to this bank alone. It goes to an investment bank, which packages its growth into securities, stocks or bonds, and sells them to investors. Those investors, institutions, wealthy individuals, later funds, capture the upside of that growth. The depositor funds the system. The investor captures its gains. This is not accidental, it is structural. The flaw is not a bug in the system, it is the system. For decades, this arrangement holds. It prevents bank runs, it stabilizes the economy, but it also quietly stratifies financial opportunity. Then comes the catalyst. In the 1970s and 1980s, pressures build. Inflation rises, global competition intensifies. Financial institutions begin to argue that the separation is outdated, that it limits efficiency and innovation. By 1999, with the passage of the Gramm-Leach-Bliley Act, Glass-Steagall is effectively repealed. The wall comes down. Banks can once again combine deposits with investment activity. The system reunifies risk and safety, but now at a far larger scale. And this sets the stage for the 2008 financial crisis. Because when risk returns to the core of the banking system, it does so amplified through derivatives, securitization, and leverage. Mortgages are bundled into securities. Risk is sliced, repackaged, and sold globally. When it fails systemically. But here's the critical connection to today. The legacy of the 1930s reforms still shapes how wealth is distributed, even in modern markets. Look at private equity. It operates largely outside traditional banking regulation, offering high returns to accredited investors. Look at hedge funds. Same pattern. Even in newer systems like crypto or venture capital, the dynamic persists. Early access and high risk correlate with outsized gains. Broader access comes later, often after the steepest growth has already occurred. The architecture built in the 1930s created a template: protect the masses, empower the risk takers. So how do you analyze this system today? 3 variables matter. First, access. Who is allowed into the high-risk, high-reward segment of the market? Second, insulation. Who is protected from downside and at what cost to upside? Third, concentration. Where is risk accumulating and who controls it? If you can answer these, you can map where wealth will likely flow. Because finance is not just about money, it's about permission. Who is allowed to take risk and who is encouraged not to? So return to that moment in 1933, the locked doors, the silent crowds, the system on the brink. The reforms that follow are not just about preventing collapse. They are about redesigning participation. The depositor is protected, the investor is empowered. And that distinction, quiet, technical, almost invisible, becomes one of the most powerful forces shaping inequality in modern history. Understanding this isn't about judging the past, it's about seeing the structure beneath the surface. Because the next time a new financial innovation promises safety and access, the real question isn't just how it works, it's who it leaves out.